One of the most common questions that I get asked is which are better, mutual funds or ETFs, or what the heck is the difference? Well, they're very similar. Both are funds that give you instant diversification. So what that means is by buying just one share of that fund, you instantly own a basket of different assets across a wide variety of different sectors or the entire market. But there are three very important differences that I think you should be aware of. First, mutual funds are actively managed. So this means there's a team of very smart individuals who are there picking which stocks and bonds or whatever the fund might be for to buy and sell. On the other hand, ETFs are typically passively managed, which means they're managed by a computer algorithm that knows certain rules. Some of them might just buy a little bit of everything across the market. Some of them might buy the top 500 companies, the S&P 500, but whatever it is, it's a computer that's buying just a little bit of everything to give you diversification. So the next thing is mutual funds have more taxes and fees. This is because to hire all those high-paid analysts, they have to have a salary. And so they will take a percentage out of your gains every year to pay those people. So that can over time weigh on your returns. Additionally, there may be some tax implications where you have to pay some capital gains that may not exist on ETFs. The third big difference is when you can buy and sell. So with a mutual fund, you can put it in order to buy or sell, but it won't actually close until the end of the trading day at the closing price. So there's a little bit of a lack of flexibility there because with an ETF, you can buy it and sell it whenever you want throughout the day at whatever price it's currently at. So it trades just like a normal stock. The other thing with mutual funds is that there's often a minimum buy-in, which means in order to start your position in this fund, you have to put in a certain amount, which can range from a few $100s to many thousands of dollars, or even hundreds of thousands of dollars. So which one is better? You might think on the surface that mutual funds are hands down going to give you better returns, right? Well, studies actually show that 70 to 80% of the time, the computer wins. If it's a broad-based index fund that does, for example, owns all of the top 500 companies of the S&P, 70, 80% of the time, that is going to beat those managers. So does that mean an ETF wins? Well, not necessarily, because there are some mutual funds that are really, really good. So if you can get in one of those top 20% returning mutual funds, you may be able to beat the market by several percentage points. And over the course of your entire savings lifetime, that few percentage points can make a huge difference to your nest egg. So then mutual funds win? Well, not so fast. Here's the thing with mutual funds. You have to make sure you're in one of those top 20%, and that changes over time. Sometimes fund managers and teams can change. Other times a strategy that worked one decade doesn't work so well the next. So at least annually, you probably need to check in on those mutual funds and decide if it's still a winner. So what ultimately wins? Why not both? I think it's probably easier to get established with a good base of ETFs. And then after you have that base built up and you can start analyzing the mutual funds a little bit, pick some good winners and have a balance of both.